Imagine yourself standing in a quiet American suburb in early 2007. The morning sun is soft, the lawns are perfectly trimmed, and every house looks like a monument to stability, a symbol of the American dream, a dream built on ownership, comfort, and the belief that tomorrow will always be better than today. Families step outside with coffee in hand. Children wait for the school bus. Neighbors wave to each other as if nothing in the world could ever go wrong. And in that moment, it feels true. House prices are rising. Banks are lending. The economy is booming. Everyone believes they are living in a golden age. But beneath the surface, something is quietly shifting, something no one wants to acknowledge. For years, interest rates had been low. Money was cheap. Banks discovered a financial engine that seemed unstoppable. They called it securitization, a complicated word for a simple idea. Take thousands of mortgages, bundle them together, slice them into pieces, and sell them to investors around the world. It sounded brilliant. It sounded safe. It sounded like the future. Risky loans became profitable products. Bad credit became good business. And the more loans the banks created, the more money they made. Mortgage brokers were encouraged to approve anyone who could sign their name. People with unstable incomes, people with no savings, people who barely understood the contracts they were signing. But the machine needed fuel, and the fuel was people. Inside Wall Street skyscrapers, the mood was electric. Young analysts worked late into the night, building models that promised endless returns. Executives celebrated record profits. Rating agencies stamped complex mortgage bundles with the highest possible ratings. Investors from every corner of the world bought them without hesitation. It was a global feeding frenzy, a system built on confidence, momentum, and the belief that housing prices would rise forever. But every feeding frenzy has a moment when the water turns red. By mid-2007, the first cracks appeared. A few small mortgage lenders collapsed. Their portfolios were filled with loans that borrowers could not repay. At first, the failures were dismissed as isolated incidents, minor players, nothing to worry about. But behind the scenes, something far more dangerous was happening. The loans inside those mortgage bundles were starting to fail. The conveyor belt of securitization was jamming, and the banks holding those assets were not small. They were giants. Bear Stearns, Merrill Lynch, Lehman Brothers, institutions older than the light bulbs in their offices. But their balance sheets were built on sand, built on the assumption that housing prices would rise forever. Then came the moment when the world realized the truth. No one knew what anything was worth anymore. The financial system runs on trust, trust that assets have value, trust that banks are solvent, trust that money will be repaid. In 2007, that trust evaporated. Banks stopped lending to each other, investors panicked, hedge funds collapsed, and the quiet cracks beneath the surface widened into fractures. By early 2008, the crisis had spread across the globe. European banks were drowning in American mortgage securities. Asian markets trembled. Oil prices surged. Food prices spiked. The world economy was shaking, and the epicenter was Wall Street. Then came September 15, 2008, the day everything broke. Lehman Brothers, a 158-year-old symbol of American finance, filed for bankruptcy. It was the largest bankruptcy in U.S. history. Employees walked out carrying cardboard boxes, their careers erased in a single morning. Markets around the world plunged, credit froze, companies could not pay their workers, families lost their homes. The meltdown had become a global catastrophe. And yet, the most shocking part was not the collapse itself, it was how fast it happened. One moment, the world was stable. The next, it was fighting for survival. Behind closed doors, government officials scrambled to stop the bleeding. They were not just trying to save banks, they were trying to save the entire global economy. If credit froze completely, businesses would not pay employees, supermarkets would not restock shelves, airlines would not fuel planes. The modern world runs on invisible lines of trust, and those lines were snapping. The crisis spread like wildfire. Iceland's banking system collapsed. European governments rushed to rescue their financial sectors. Export economies trembled as global demand evaporated. The meltdown was no longer an American problem. It was a worldwide shockwave. And at the center of it all were ordinary people. Families who bought homes at the peak of the bubble watched their property values collapse. Workers who spent decades building careers were laid off in a single afternoon. Retirees saw their savings evaporate. The crisis was not just numbers on a screen. It was fear in the pit of your stomach. It was the sound of a foreclosure notice being taped to a front door. It was the realization that the system you trusted had been built on illusions. But the most haunting part was not the losses, it was the revelation of how fragile everything truly was. For years, Wall Street believed risk could be engineered away, that with enough math, enough models, enough innovation, the system could become unbreakable. But the models were built on assumptions, the ratings were built on optimism, the profits were built on leverage, and the entire structure was built on the idea that housing prices would rise forever. When that idea died, everything else died with it. In the aftermath, the world entered a long, uneasy recovery. Construction sites froze, office lights dimmed. People spoke about the crisis the way survivors speak about storms, with disbelief, relief, and the lingering fear that it could return. Governments launched investigations, new regulations were drafted, banks were forced to hold more capital. But beneath the reforms, the same forces that fueled the bubble still pulsed through the system: ambition, innovation, competition, the relentless pursuit of profit. And that's the paradox of the meltdown. It exposed the dangers of the system, yet the system survived. It revealed the flaws of human judgment, yet humans continued to build, invest, and dream. It showed the fragility of global markets, yet those markets grew larger, faster, and more complex than ever before. Before 2008, the world believed in the myth of endless growth. After 2008, that belief was gone. The crisis had shown that prosperity is fragile, that systems must be questioned, that trust must be earned. And as the world stepped into a new era, one question lingered, a question that still echoes today. If the system broke once, what's stopping it from breaking again?